Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a hedge fund manager at Crescott Capital. He is in must follow on Twitter. Absolutely superb charts released for free on his Twitter all the time. Tavi Costa, thank you for joining me.
Jason, thank you for having me again. It's almost always a pleasure to be here with you.
Yes, and you had some great calls about 3 or 4 months ago. The last time you were on, you thought oil had bottomed. It's rallied strongly. So we'll get your thoughts on oil a little bit later in the interview. I want to get your thoughts now on what I'm hearing when I talk to a lot of other financial professionals, that they don't really care about valuation anymore, fundamentals. It's all about, some of them anyways, it's all about front running the Fed in terms of what the Fed's going to buy next, if the Fed's going to publicly announce buying stocks. So I've heard from people that I've spoken to, some of the people I've spoken to, that they're just buying the general stock market indexes and the FAANG stocks with Microsoft. Also, they're front running the Fed in corporate bonds, investment grade, and U.S. Treasury. So what do you think about that and front running the Fed right now? Are a lot of people you speak to also doing it?
Well, it's a clear sign of how the sentiment is euphoric. We've seen a lot of bears capitulating recently, all those Robinhood traders now emerging, mocking Warren Buffett and bidding all these bankrupt companies and saying fundamentals don't matter. I think this is all happening in the last few weeks or so. That certainly has intensified. To answer your question is in my view, especially the tech sector that now makes up close to 37, almost 40% of the overall index of the S&P 500. That's including Facebook, Amazon, Netflix, and Google. But it's astonishing how much weight we have reached in this whole sector, of a sector that actually only contributes to 10% of the aggregate revenues of this index. So I think there's a lot of issues under the surface still. We're not seeing profit margins improving. The matter of fact, they're falling apart. We're seeing capex also hasn't really rebounded much. So the macro environment is severely impaired in our view. And Powell does have a unlimited power. But it's also painted into a corner in our view. It can keep printing and have gold and silver and miners surge, which has been the case recently, or it can stop it and let the whole thing collapse. I don't know where they're going to do. I have perhaps I would believe that it would keep printing until they can't. And so it goes back to the whole idea of buying gold and selling stocks. I don't think money printing really fix the economy. We've seen that, economic activity has been plunging while we've seen the Fed's balance sheet rising significantly. In a total contrast with equity valuations at record levels right now. Restaurant bookings are slowly moving higher. They're not improving significantly. We see those TSA number of travelers also showing the same problem. So certainly there is no rock ship recovery that we heard of in the past. And you mentioned the corporate bond yields. That's a critical part of the market. As we all know, corporate bond yields are now at record lows, which makes no sense having corporate debt at record levels. So it's, just for the average person out there is, corporate bond yields being at record lows is not a sign of the bottom of the market. It's a sign of a market top, in my view. And I think the only reason why we're seeing this is because the Federal Reserve is being able to manipulate that market. And the question is, until when? And so clearly the Fed is painted into a corner in a way. If they stop doing that, corporate bond yields will probably surge a lot higher given the fundamentals of a lot of those businesses. I just showed a chart of restaurants, total debt to total assets surging. We have McDonald's today, over 100% total debt to total assets. That never happened in the last few decades of this firm. It's the first time in history that McDonald's is this levered. And so there's a lot of imbalances out there. And unfortunately, we still see equity markets at record levels, which for us is still an opportunity to short the market. We'll still continue to be long precious metals and short equity markets overall. It worked well, and one part of the leg worked well in the first quarter, which was the short side. And now the second quarter certainly came from a lot of the attribution of the performance came from the precious metal side. And I think this is only going to continue. Clearly, that's the corner, and for me, that's the best positioning I can think of.
We're recording this interview on Friday, July 24th, 2020, if our listeners want the exact date. But to add to your points there about the real economy, I just don't see a lot of data that the real economy is improving. The Fed can print all it wants, but it's just going to create, in my opinion, even more distortions. Like what you said with the corporate bond market, the European Central Bank was doing this, and all the investment bankers, all the hedge fund managers, all the professional money managers in the European Union were just front running the European Central Bank. So the yields were going down on corporate bonds. For our listeners who are not familiar, when the yields go down, that means the value of the bonds go up. So this was not based on fundamentals. The bond bull market that the European Central Bank was causing in government bonds and corporate bonds in Europe was not based on fundamentals at all. And I think this similar situation is starting to play out here.
And also, I think this monetary stimulus is not so much new liquidity in the markets, but instead it's just being used to fund fiscal stimulus first and foremost. And when we look at the amount of government borrowings, which in the last month was somewhere close to $700 billion, we see a net withdrawal of liquidity in the markets. The median stock in the Russell 3000, excluding technology, is still down about 20%. So, if you look at consumer discretionary earnings, it's still down close to 60%. So there are a lot of issues in the markets still. And I think it's going to be really tough to see a growth environment when you have low yields, record leverage, and record valuations. So it's hard to rationalize a revamp in organic economic growth going forward. Look at the banks. Banks look awful. U.S. yields continue to move lower. You have 2-year yields probably heading negative in my view, and banks continue to underperform. Wells Fargo is down over 50% year to date. It's the 4th largest bank with over, close to $4 trillion of assets. So there are some pretty big signs going on in the markets already, in my view. And remember, this issue with what we're seeing with money printing, it only magnifies the inequality problem. Since the QE1 that we had, it started back during the global financial crisis, the less financially privileged parts of the society have suffered from the shrinkage of wealth relative to the overall pie. And I think this is only going to continue to create more protests and issues that we've seen recently intensifying in the last few weeks. And I think this is only going to continue too. It all questions, how do you justify the levels of valuations we have in equity markets? It makes you think, when you can find an industry that is growing free cash flow, that it has a cleaner balance sheet, that is supposedly will benefit directly from all this monetary experiment, which I'm talking about the mining industry. It's a huge contrast with tech companies, for instance. Right now, they are not even growing any of their fundamentals today. Matter of fact, it's quite the opposite, while equity prices continue to move higher. So, there is a value exchange here for buying miners and selling all those record overvalued stocks across the globe today. And I think there's a asymmetry in both sides, and it will probably be, in my view, one of the best trades you can do in the following months.
Most people are not aware of this with the S&P 500, but it's really just the FAANG stocks that are up. I think the 5 or 6 FAANG stocks out of the 500 S&P 500 companies are up 35%. They've rallied since, I think, the end of March or first week of April. Meanwhile, the other 495 companies, they don't have a lot of cash. They have bad balance sheets. They're not doing well in the real economy. And I think those stocks collectively are still down 5% overall since the crash started in February. And then we've had the rally.
Yeah, and I suggest people to use median metrics to look at the markets. I mean, you can look at valuations all across, so many fundamental metrics, from price to sales, price to book, EV to EBITDA, cyclically adjust PE, whatever that is. Most of those are all near all-time highs today, and that's using Q1 numbers. Q2 numbers are coming out. Most likely, we're going to be at record levels across the board. I think this is all, we're in an economic conundrum, in my view, where there's no economic growth in the economy. Probably we have extreme corporate and government debt levels, and it forces the government to maintain deficits at an extreme. So with that, we're likely to see more and more net Treasury issuances going forward, which forces the Fed to continue to be the buyer of last resource. And it creates two dynamics when you think about that. It expands the monetary base and it suppresses the long-term rates, which I call that a supercharged environment for precious metals. So it's the perfect storm for precious metals in my view.
Yeah, I was going to ask you about the M2 money supply growth at 25% approximately year over year, what you thought that meant. So clearly you think that that's going to be tailwinds for gold and silver.
Yes, I think we're in a race to the bottom for all fiat currencies, and the dollar looks fundamentally stronger than any other fiat currency in the world today. When you look at things like the S&P 500 to gold ratio, we're still above the pre-Great Depression times highs that we were before that crash. So you can think about it: is this a really inflationary environment or a recessionary environment in which creates more of deflationary impact? I don't think we really need to answer that question because if it is a deflationary environment, what we're going to see is probably lower yields. In which sovereign bonds. I just showed a chart recently looking at sovereign bonds or bonds in general with negative yields. And when you can look at the price of those bonds as being basically breaking out recently, which is another reason for investors to be buying precious metals. Why would you buy a bond yielding negative today if you can buy precious metals, silver or gold at basically record undervalued levels relative to money supply or monetary base? Now, if you have an inflationary environment, the Federal Reserve, it's important to remember, the Federal Reserve owns pretty much the inflation expectation in the markets today. The tips, the so-called tips, are, close to 30% of the overall market of tips today is owned by the Federal Reserve. So, in one way, they're going to probably keep inflation expectation low. And if they do that, it's another reason for that supercharged environment. At the same time as you have commodities to equity ratio to equities ratio close to a 50-year lows or so. So I think we're in an environment where it's almost irresponsible to not own gold in a portfolio. Number one, and if you're looking for growth, I think that the only growth industry in the world today is probably the mining industry. Again, it's the only industry that benefits from all this money printing that we're seeing worldwide.
Yeah, I totally agree. What are your thoughts on the U.S. Treasury general account getting to 1.8 trillion? It's getting ridiculous at this point. Why do you think it's grown so much?
That's a tough question. I don't have a lot of insights on that, and certainly seems sketchy in a way because you don't know exactly what is going on, if it's related to the elections or are they really building a buffer for all that? I mean, it seems way too much money and the cash balance to be a buffer for what they call a buffer. I believe it was a cyber attack or something. And I don't think that that's the case at all. But clearly there are some issues, underlying issues in the economy. And I don't know if that's related to that or related to some strategy that relates back to the elections again, as I said. So yes, I don't have any insights on that, but it's certainly something I've been watching as well. We've just had the Federal Reserve yesterday publishing their numbers of their balance sheet. I think we saw a slightly increase in their balance sheet assets again. And the numbers of government borrowings take a little longer to come out. But what we see is the deficits are not improving at all. Now everyone is talking about their stimulus check. We just heard about perhaps the unemployment, the benefits might be cut from $600 a week to $100 a week. And at the same time as you have, used car prices at record levels. I mean, what do you think they're using their money for aside from trading daily here, as we all heard that story. So I don't know exactly what the government is going to do, but it certainly is, as I said, an economic conundrum in the sense of it doesn't have organic economic growth today. And I don't think it's going to go back to those levels when you have record low yields, record leverage, and record valuations. I think that we reached an exhaustion of credit here in the U.S. and globally. and probably this is going to continue to be a problem. And most investors will be looking for alternatives of the monetary system as they begin to really challenge their thoughts about what is the dollar, what is the Chinese yuan. I mean, what are those currencies backed by? Is it really backed by a broke government? And I think most investors are beginning to wake up to those questions, and more and more this is going to be I think on the news.
Yeah, I see all these central bank balance sheets being forced to rise in the not too distant future. The Fed's balance sheet for, I think, since June 10th is down around $204 billion officially, but I just don't see the math working, especially when the real economy is not anywhere back to pre-coronavirus levels. It's not generating the cash flow that society needs. How worried are you about the commercial real estate bubble?
Yeah, I don't have a lot of insights on that one either, but it seems to me that, especially in places like New York, from what I've been reading and looking at numbers as well, seems to be a little more problematic. Places like San Francisco, especially with the protests that we're seeing more recently, where people have been moving to, more, I guess, more in the country place. And I think that's a real trend in my view. Now, I would love to buy a house right now in the country place. I just don't think the valuations look, anywhere close to where I would like to pay. So I'd rather buy gold and miners and grow my capital instead. I think there's the real estate market is looks troublesome in a way, especially the commercial real estate market. I think we have some shorts in those here in the in our funds in the US, and I don't know exactly when it's gonna derail all the issues, but we're seeing definitely an underperformance for a lot of those REITs that are linked to those markets in the last since the March lows really, which challenges where the market is today. Which all this rally, as you pointed out, has been masked by a lot of the technology companies that have been performing incredibly well, which in my view makes no sense because people forget that technology businesses are cyclical. And a lot of those companies actually make money on advertising, and advertising is one of the most cyclical businesses in the world. So anyways, one trend that we've been seeing that is, I think it's very important to follow, and it's so easy to follow, is just looking at ETF assets. When you look at total assets for ETFs like GLD for gold versus the SPY, you can see that has gone to, in my view, an upward trend on capital inflows towards GLD. And I think that's probably going to continue as we see, especially that whole cup and handle price, as I showed before, of gold adjusted for inflation, over the last few decades. It looks incredible. I think we're had a much higher in terms of that, and I think a lot of people are not positioned for this bull market in precious metals in general.
I think the reason the bank stocks are so weak, Tavi, is because of the commercial real estate market. Wells Fargo has an absolutely enormous commercial real estate loan book. They have the largest. So they were trying to focus on loans to the real economy, but now that's been backfired since February.
That's a good point. It's likely true. And it's also, in my view, also related to the lack of growth in the economy as well. Like, economic activity is not improving at all. Even the Federal Reserve's indicators of economic activity that you can look at look absolutely awful. So, some people are calling for the bottom of the business cycle here, and I really don't agree with that. I think we're headed to a long-term, more problematic period in the economy, in which will force the Federal Reserve and the governments to continue to stimulate the markets, and that's the whole reason why I think metal prices will move a lot higher.
You put out a great chart recently about the monetary base, the amount of money supply growth versus the silver price, and how the silver price has a lot of catching up to do. So you think then that silver is going to start to outperform gold a lot now going forward?
Yes, I think silver, was centuries ago obviously used. It was part of the monetary system, and today hasn't been used so much because of the price of it as well. And it's being used in more industrial forms, and in which, if silver prices increase significantly, I doubt it will be used for that as well. Now, you're referring to the gold to silver ratio. which used to be what an average, a historical average is somewhere close to 56 or so. Right now we're close to 90, so over 50-60% higher. So in the peak of 2011, we got close to 31 in that ratio. So I think there's a lot of gold there. If you look at silver relative to equity markets, I've said this chart before. Just look at silver versus Russell 3000 total returns. And you can see there that very clearly we are in a double bottom there in that chart. And when you look at relative to money supply, as you said, M2 money supply, very clearly as well, silver is incredibly mispriced relative to how much money we have in the economy today and credit. So back in 2008, the Federal Reserve, in the very end of the crisis, I would say in October or December, not the very end, but in the end of it, and the later part of it, we saw the Federal Reserve printing close to $1.2 trillion in like 4 months or so, and silver went parabolic for the last 2 years or so, and we just did over two times that amount. If I think that we're going to continue to print money here, which I do, I think silver could. There is a case for silver to go parabolic here very soon. There's a very high probability of that. And the chart you're referring to of the money supply just shows that there's tremendous opportunity still ahead for this metal to rise. I think it's the cheapest metal on Earth today.
Yeah, some of the other metals are starting to break out too. I think platinum and some of the others, but the gold to silver ratio, it was just absolutely ludicrous not too long ago. I think it was 126. It got as high as a record high, 126 ounces of silver to 1 ounce of gold. It was just totally ridiculous. I've never seen anything like it before.
Oh yeah, it was ridiculous. Silver was even cheap relative to oil more recently. I couldn't believe. But anyways, it's finally catching up. I think the miners have to have more to catch up. I've heard people coming up to me and saying, why are the miners not up as much as silver prices are in the last week or so that silver has been surging? Well, for the same reason as gold was rising in March and silver wasn't following. I think it's an opportunity. I think this whole industry's had a higher. And I wouldn't be, I wouldn't be too focused on why, an industry is not following so much, the silver prices right now. I think it takes a little longer for people to warm up and start buying, especially the segments of the drill stories and the junior X producers and so forth. It's a lot easier for a lot of investors to warm up and go ahead and buy, the royalties or the senior producers. And there's nothing against them. I'm just saying they're easier to look at. And so it takes a little longer for people to start warming up to the other parts of the industry. And I think it's still an opportunity on those parts too, which, there are a lot of companies that don't deserve to be rising in this environment because those miners are probably not don't have prolific projects, don't deserve to be part of this rally at all. But I think if you're selective, there's quite a lot of opportunity in this industry today.
I think people can clearly see on the charts, and I know you spent a lot of time looking at this too, because we've discussed this in the past. It just seems like it's a classic bull market where a lot of the best either gold mining stock ETFs or the best gold companies like a Franco-Nevada and some of the others that have the best fundamentals, the dips are being aggressively bought. So the timing might not be perfect on all the dips that are bought, but if you go back since March, anytime there's like a halfway decent correction, there's clearly dip buying.
Yes, I agree. I mean, fundamentally, if you look at the industry, I just posted a chart of the capex cycle of this industry when you aggregate the capex for the overall industry or the top 50 miners. And you can see clearly that gold prices have been rising significantly, but the capex, aggregate of capex has actually been declining and diverging from the metal prices, which is something that never happened before, actually. And it makes me think of two scenarios. I think miners either think that they are in 2016 again, an environment in which gold and silver prices began to rise and then took a pause for the next 2 years, and silver prices actually declined significantly from those levels. And a lot of companies actually went bankrupt and liquidity completely dried out in this industry. I think, and the other reason for that, for why capex is not really increasing at the same time as the metal prices have been rising, is perhaps because we talked to a lot of CEOs in this industry, and a lot of them are actually thinking the metal prices will be much higher in a few months. So they're all holding up on capital spending, hoping that metal prices will be higher so they can start really producing. This is fundamentally bullish for this industry, as supplies already has been constrained for so long. We haven't seen any new discoveries, major discoveries in this last decades or so. And, I think that a lot of the drill stories that have, they're holding good deposits out there will be bid up by a lot of the more senior miners in this industry. And if you look at the mining industry as the sector today, it would have the cleanest balance sheet of the overall market. Today has median debt to assets somewhere close to 17%. If you look at the S&P 500, somewhere close to 35%. While you have tech stocks trading at 30 times sales, 40 times sales, 70 times sales, with earnings declining 20% or so at least on a year-over-year basis today, while free cash flow for those miners is supposed to double this quarter, and a lot of those junior miners are actually trading at 10 times free cash flow today, 5 times free cash flow, depending on the miner. Wait until the Robinhood traders really hear about the gold and silver penny stocks. I think this is going to be a very speculative space at some point. And, it's still, the mining industry is still it represents close to, 0.7% of the global equity market today. And the entire industry is worth 3 times less than Apple's market cap. So, think about the asymmetry here in the following years. If we're going to continue to see money printing globally, along with no economic growth in environment going forward, I think it's going to be, it's a real opportunity here.
There was a bear market from 2011 to 2018. Capital was not available. Mining companies went bust. Senior executives got fired and lost their jobs. So a lot of the waste that was in the gold mining industry and silver mining industry, it was wrung out.
Yes, and it was sad to watch. A lot of the gold bugs that have been, using a lot of their knowledge to try to profit from this industry, unfortunately there's no way around this. You can be the best geologist in the world, but you have to get the macro side right to be successful investing in this industry. And by that I mean, you got to get the gold and silver prices right in terms of rising here. If there isn't a rising environment for those two metals, forget about it. The mining industry is gonna, it's gonna be drying out capital very quickly here again. The miners just had their best quarter ever in the second quarter of 2020, and it was close to 44% above the S&P 500, 30% above Nasdaq, and I think was 20% above Bitcoin. So we like a lot of the miners here. And again, I know you're a fan of the whole Chinese devaluation and a lot of emerging market currencies devaluations. I think for people that subscribe to that view, I think you should be looking at a lot of miners that have production outside of the U.S. It's another way to be long gold versus the most overvalued currencies in the world today, as they have a lot of significant forex exposure, especially in a lot of their costs is denominated in foreign currencies. So it should boost their margins as their currency actually depreciate. You would expect their costs to also decrease significantly as the metal prices increase. It should obviously expand their margin significantly going forward. So it's another way to play this, being long gold versus the most overvalued currencies in the world. I think it's a pretty interesting approach.
We're at right around $1,900 an ounce gold price today. Do you think the magic number is $2,000 an ounce or a little bit above that, and that's going to start bringing in even more financial professionals that are mainstream, generalist money managers and also more retail investors, that number, once we cross the $2,000, because I would classify gold, it's like a Giffen good. So gold is one of those rare items where the higher in price it goes, the more demand it creates. So most economic goods are by fully supply demand. And if the price goes high enough, demand actually drops. But I think gold is one of those rare exceptions where if the price of gold goes to $2,000, $2,500, $3,000, the demand could actually potentially increase.
Yeah, and it's also important to think about the large allocators, the big pillars of the economy, of the pension funds of the world, and all those guys that have been under allocating capital towards the precious metals industry. That is still about to change, in my view, especially with all the amount of negative yielding bonds that we have worldwide. So yeah, I think this is when the retail investors begin to see, especially in the Wall Street Journal or all the media, that gold prices are making new highs and all that, which it's kind of the case right now. Now we've been kind of, gold and silver have been on the news recently. This is what kind of starts warming up this entire industry. Also, wait until the fear of missing out, the FOMO, starts with the silver prices. And when people really start thinking that they're missing something here in terms of silver, I know that's when you have those parabolic moves, like silver goes to 50 or so. There is a pretty high probability, in my view, the silver will be at all-time highs in a few years here. I don't even know if it's going to take a few years. It might even take a shorter period of time than that. We've had a big, long, run here recently, and I think for an investor, it's important to start looking at ways of smart hedging that exposure. Which, by that I mean looking at a possible move up here in the dollar, which has nothing to do that it's going to be the end of this bullish trend for the precious metal space. It's just I think that the dollar is incredibly undervalued relative to other currencies in the world today. And when you look at emerging markets, especially in terms of equities or currencies, they're starting to look very appealing as a short. And so you should, in my view, have a exposure to precious metals and the miners, and along with the metals. But also, I think you should be looking at ways of hedging that by looking at shorts in the emerging markets space. I think that those look also a little bit too stretched, in my view.
For emerging markets, do you think that a lot of this is based on China and how the real Chinese economy is having all these problems with the flooding and the rains and so many, and how there's not a lot of orders, I guess, for a lot of their manufacturing? And then on top of that, you have all the recent news with Pompeo giving a speech and the U.S. trying to shut down consulates in Houston, Texas, and other areas. So it appears that this Cold War 2.0 between the U.S. and China, this escalation, there's going to be economic sanctions back and forth. So do you think then that that's going to, the emerging markets and other industrial commodities are going to be the collateral damage then from the U.S. and China fighting each other economically?
Yeah, I believe strongly that has a lot to do with the environment in China. As you know, the premise of our thesis that China has the largest credit bubble in history is the growth in the banking assets of close to 400% normalized growth, and since the global financial crisis. And it goes back to the whole idea of the Thucydides trap from Graham Allison book, which shows the rising power that challenges established power as well. I think all that is linked to the issues that we see today. We see equity markets in China moving higher recently, not yesterday, as you know. There was a big decline in equity in equity prices yesterday, but large cap is still already trading higher valuations than the peak of 2015. Last time I checked was somewhere close to 14 times EBITDA. And when you look at the small cap space, it's not as high as 2015, but it's still close to 70 times EBITDA, which is it's crazy. So we're seeing outstanding margin balances that keep rising, and CNH briefly went below 7, and then just went again back above it, and it's been consistently above 7 since March, even with the dollar being so weak. So this U.S. and China relations are obviously getting worse, and I think that Trump's tough stance on China has become sort of a centerpiece of his campaign to stay in power, I think. And when you look at Xi Jinping, it has strengthened his nationalist image recently by asserting those claims in South China Sea, and I think that's going to continue, obviously. But he is the most powerful and most aggressive, geopolitically speaking, Chinese leader we had since Mao Zedong. So they're spending billions and billions of dollars in military investments to secure the South China Sea and some other areas, and this consulate closures that we heard in Texas, is in China, I think it's just the icing in the cake. So Mike Pompeo, as you said, I think is certainly has been a key messenger of the issues that we're seeing, and with meaningful statements unmasking the true state of the U.S. and China relations. I think this is only going to continue in terms of a problem, and I believe that the Chinese currency will continue to devalue going forward. It's hard to think of rationalize a thesis for why the USD and CNH should be lower. I think it will be a lot higher in the next 2 to 3 years, and that's that's going to have a lot of implications worldwide. And emerging markets will fall into that category of having issues. And so if there is a pause here in terms of rise in precious metals, I think the first place that will get hit will probably be emerging markets, along with the equity markets in the U.S.
Yeah, I would also probably say copper, which has rallied enormously from about $2.08 a pound, I think, towards March 23rd. I think it bottomed around $2.08 a pound. And I haven't checked the price today, but it was around $2.80 a pound the last time I looked at it. So it's had an enormous rally. The last time you were on, we talked about the oil market. You thought 3 months ago or so, the last time you were on, that the oil market had bottomed. You were correct on that call. I thought the oil market was going to be weaker because I thought the big oil companies had a lot more pain. They might still have pain with the Q2 earnings numbers. So what are your views on oil right now? Do you think if the Chinese economy starts to roll over and more problems, that the demand for oil is going to collapse again and that the oil price could have another correction?
Look, given my views on China, I obviously never really liked oil to begin with. But what happened in March, and when I talked to you back then, was I think oil went down too much. And there was an asymmetric bet on the long side, especially if you have a short book, which was the case here at Crescat. So, we were short the market, and we thought, well, if we're wrong, which is something we always are constantly thinking, how can we hedge this exposure in a smart way? And our view was that, if the economy is going to go back to normal, was that, you wouldn't be seeing oil prices trading below $30 a barrel. That was number one. And actually, oil prices went even negative back then, as you remember. So it gave us the conviction to really go a little bigger in that trade, which is completely outside of our core, a part of the positioning here at Crescat, as we're, the biggest, the three themes that we're really focused is the Chinese credit and currency bubble, the decline here and the downturn in the economic cycle globally, and the precious metal side. And so oil does not fit in any of those pictures besides, on the short side, perhaps. So it was a little hard for us to understand how to position the portfolio in that direction, but we did. We bought oil. We bought a lot of oil companies at the time, and it worked out well. And then we sold them. We have 0 positions on oil today. We have a few tankers, but it's not related to the oil market at all. It's very small exposure, matter of fact. But it's I think oil is still we're not oil is not going away. Number one, it's still going to be a main consumption of for fuel and all those things. And I think that the point there was, if there was any sort of growth in the economy, oil was incredibly mispriced relative to that. Now, not so much. You look at CFTC positioning for oil, it's now near extreme levels. It just doesn't seem as attractive. Can oil go higher? Yes, we're not short oil, by the way. I have 0 positions on oil. So I just don't have conviction right now. But if I believe that the economy is going to have a big downturn, I think oil can get caught up on that, obviously. But after a 30% drop in equity markets, you got to start thinking about where you can get a little bit long, especially when a sector like oil was incredibly depressed in terms of valuations, in terms of relative to overall S&P 500 index, in terms of versus the global equities. And so forth. So that was just a sort of a trade, not so much a long-term investment. We're much more excited about the long-term possibilities here for the precious metal space, as I've said it before. As I think that's something that will sustainably move higher rather than just a short-term move. Who knows what oil companies are going to do in the next 6 months? I really don't have a strong view on that today. But back then, I definitely had a bigger view, and I think I had enough reasons, especially when you look at the credit spreads at the time, that were so wide historically. We never had those, and with the contango situation also so extreme. So there was a lot of historical indicators of the oil prices maybe bottom at the time. I think that ended up being the case. And the funny thing was that when oil prices turned negative, a lot of oil companies actually did fine. There were some of them were up, and I know that because we had it in the portfolio. And I was freaking out. I thought, well, if oil prices are going to be down to negative prices here, well, probably those oil companies are going to be down significantly. No, a lot of those are actually up on those days. You can see it, and it's, a lot of the exploration businesses in oil space were actually up. And that was surprising because when you start seeing those companies actually rallying more than oil prices, that tends to be a sign that the oil markets have really bottomed. And that was the case. Now, moving on to new ideas, I'm over it with oil.
Yeah, I'm a lot more cautious about industrial commodities and the other commodities other than the precious metals because of the global economy. I just don't see it recovering that quickly. China uses so many different commodities for food and energy and metals. If the Chinese economy has problems, and the other metals, the other commodities are going to have enormous problems too.
Yeah, I agree. I mean, as the largest buyer of oil today, and it will certainly have an impact, especially if you believe in the Chinese renminbi devaluation versus the dollar. I think that should have a huge impact on oil prices. So all those cyclical commodities, we're also not as excited either. There are some drill businesses that were a little bit excited on the copper side because there has been a lot of closures of mines, as you have pointed out before in your channel. And if you're okay investing on something, it won't be really seeing return in 2 to 3 years. There are some opportunities there. If those companies don't really go bankrupt in the following years, they could be big winners because we're also having issues of new discoveries in the copper space too. So there's some opportunities there, but it's definitely not the same level of a setup that we have for gold and silver with, especially what we're seeing in the monetary side of things. I can't stress enough how bullish we are on miners and gold and silver. I think that's the only long position that makes sense in the markets today.
Yes, and gold and silver companies have better balance sheets than oil companies. I think in the last 5 months, a lot of the larger oil companies, national oil companies too, $80 billion has been borrowed, more debt in just the last 5 months. So unless oil prices go higher, if they go lower or flat, there's going to be hell to pay in the years to come with all that extra debt that's been borrowed for the oil companies.
Yeah, see, that's a good point. I think that a lot of the capital intensive businesses are reluctant to spend capital, and oil, the whole oil sector, energy sector is a huge part of that, and it makes you think about labor markets, right? If capex are not increasing significantly for the overall economy, now how in the world we're going to see labor markets returning back to normal? I really don't think that that's going to be the case. Matter of fact, you saw my table yesterday showing initial jobless claims actually had a weekly increase, the fifth largest weekly increase in 50 plus years. I mean, it's significant. It's still rising. It's not getting better. Well, and I can't believe that people are, first of all, I can't believe that equity markets are record valuation, number one, and that people still try to come up with a bullish thesis in this environment. It really, I don't understand how, it's almost sad to see a lot of actually retail investors coming back to the market in a big way, as we've seen a lot of day traders coming back here. What's going on? Do they think really that the economy is going back in the next 6 months and we're going to be, airlines are going to be back surging again and everything is back to normal? I mean, come on. I think that there's a lot of underlying issues in the economy today that a lot of those guys are not paying attention to. And tech industry's price, or tech sector, is priced to perfection, as I've said it before. And I think that the labor market is a whole new recession here that is showing a lot of issues, and probably we're not going to see any improvements going forward.
Well, the PPP loan program, unless they extend it again, a lot of those loans, the grants are expiring soon, which means the small business owners or the medium-sized business owners that got those grants, they're going to have some tough decisions to make on their employees.
It goes back to that idea. Either they're going to save the equity market by having the Federal Reserve print more money and fund fiscal stimulus, right? And then what's going to happen with gold and silver and miners? They're going to rise probably in that scenario. And the second scenario would be, look, we got to stop doing this. The deficits are too extreme, blah, blah, blah. Well, how in the world the equity markets deserves to be in record valuations? It doesn't. I mean, it just doesn't. On the balance sheet perspective, from a valuation perspective, from a yield perspective, I think there's definitely a corner there in which they got to pick one of the two. And therefore, I think gold in relative to equity markets will continue to rise. When I say gold, it's not just gold, it's gold, silver, and miners. That's why I like that buy gold and sell stocks idea. I think that's still gonna work in the following months and years. And remember, this whole idea came about because of the yield curve inversions back in 2019 in August, when we got close to 70% of the yield curve in the US was inverted. In other words, all the possible spreads in the yield curve turn negative. And it's incredible now that this idea is still alive and strong, and I think it's going to continue to work for the next 2 years or so, unless there's a huge appreciation, in metal prices that is way faster than I initially thought. So, anyways, I think we're here for the long haul in this idea.
How much of the stock market rise do you think is the passive investing bubble, what Mike Green has been talking about, where people are just putting money into their retirement accounts and it's just indiscriminately buying the stock market index, or it's market cap weighted and it's just going right into the FAANGs?
I think there was some of that, especially before the coronavirus situation. But more recently, I think people have been bidding up, specific companies, specific industries, looking for, people have too much time in their hands. They don't want to buy a boring ETF that owns a ton of other companies. Yes, there's some of that in the leverage space. Just do a favor for yourself and join a I've done this, and it's very interesting because I'm always trying to gauge sentiment. It's very hard to gauge sentiment. You can look at Tesla prices to gauge sentiment. You can look at so many ways, and even Twitter. Now, if you go to Facebook, there's a few groups that you can join about stock market. I don't post anything there. I just watch. And it's very interesting how, people really think that a lot of those companies, airlines, are just, it's just a easy money. It's just, they're going to make money for sure by buying those stocks. And obviously I disagree with that, but it's astonishing that, a post on Facebook gets 400 or 500 likes of a person just saying that is buying, looking into buying some, some tech stocks like Zoom or even some other businesses like in the airline space. I can't believe that that's still the message is so overwhelmingly bullish given the environment we're in today. And it has to do with the fiscal stimulus that it provided, time and money for those to really begin to participate in the market. With something that we haven't seen in the cycle much was the participation of retail investors, the same level we're seeing right now. I have friends messaging me, asking for stock tips and things like that, things I've never heard before. And clearly there's a shift in terms of the sentiment more recently, and it has to do with a few influencers and people on Twitter joining the equity markets in general, thinking stocks only go up. And personally, I don't believe in that at all. I understand business cycles, and I think that most investors that do would agree that valuations look really rich compared to where economic activity really is. It's probably the biggest divergence we've seen in history.
Also, up until yesterday, there was no professional sports here in the U.S. to bet on. So those professional sports bettors, they weren't going to the casinos, they weren't going to the sports books, they weren't able to bet online for American professional sports. So they wanted to bet on something, and they just went into the stock market like Dave Portnoy, Davey Day Trader. I mean, he was a good example of he's a professional sports gambler.
Yeah.
So he was a good example of a lot of other professional sports gamblers who have gone into the stock market for the last 4 or 5 months.
Yeah, and I agree with you. And again, I have nothing against the retail investors participating more in the market. I think that the problem is that quick money mentality that we're seeing, or get rich fast mentality. Sorry. So I think that that's certainly something that has happened recently, and probably will continue until we stop seeing money printing. And I think that if there is a case to be made here that a lot of those guys are going to start merging towards precious metals, because they're going to realize the value of, especially if silver begins to rise significantly. Think about the opportunity of this becoming a bubble one day, which you were talking the other, before this being recorded, of how many terrible companies in the mining space. And I agree 100% with you. So many of those are probably do not deserve to be rallying here, along with precious metals. But unfortunately, that's how you create a bubble. And at some point, this will become a bubble too. Look at 2011. The only difference is that we're incredibly cheap levels right now. Now, there's no problem riding a bubble up. So I think there is a case to be made that the speculative minds of investors today might join the party in terms of the precious metals ideas, and especially the penny stocks and all those that they, kind of like what we saw in the crypto market, very likely could happen the same way here.
Yeah, I totally agree. It's human nature actually to create bubbles, because the rational markets theory that everything, the market participants are all rational players, that's not how human beings normally make investment decisions. They oscillate between greed and fear. So yeah. I think for gold and silver, at a certain point, anything with gold or silver in its name is going to be on the greed side. So yes. Anything with the word, any companies are going to change their name. Shell companies in Vancouver are going to change their names to gold and silver that were in marijuana or crypto, like you said, or lithium. And they're going to go back to gold because 10 years ago they were in gold, and then they had to change their names 5 or 6 times to try to raise any capital.
Yeah, you made such a good point of changing names, because I was just discussing this with Kevin, a partner, and what we were talking about was it's so hard to find, obviously, a pure silver play, right, as a miner. And the idea was, a lot of the silver miners that still have the name silver in the name as part of the name of the company, have claimed not to be silver plays. They all try to claim that they are gold, they have a much higher exposure to gold and other metals in general. And, it's funny, because just wait until silver prices begin to really rise here. What do you think it's going to happen? They're all going to go back and say, "No, that's why we picked those names." And right now they've been, kind of, hiding away from having silver into their business names. And it's probably going to happen soon here, with silver prices, in my view, are headed a lot higher in the following months. And if that happens, it's going to be difficult. A lot of the silver miners that we talk to have been holding up on silver production. Again, it's just another reason for you to be buying precious metals because of that. I guess supply has never been so constrained. And remember, if you are a drill story, if you start today and you buy a property and you want to be drilling in that property to mine gold and silver, assuming there is gold and silver in that property, underneath that property, well, it's going to take you at least 5 years to start doing that. And so, it takes so much time. So there's definitely a mismatch of supply and demand, in which demand has been surging and supply has been stalled. So I think it's going to be a interesting market going forward. And by interesting, I mean, I think we're going to go a lot higher.
Last question here before I let you go. Thank you so much for your time today. You've been very generous. I know you're a successful hedge fund manager, but what do you think about the financialization of the economy, of asset markets, and all these extra leveraged gambling, speculative bets in derivatives and leveraged trades that university endowments and pension funds are putting on, where CalPERS is talking about leveraging up assets under management by 20% and increasing the risk parity trade and adding their exposure to private equity. And then you have these university endowments that raise tuition prices every year, and they're taking all this capital that they're making from tuition, or at least they were prior to the global pandemic, and then they're turning into hedge funds and putting on all these leverage trades with the leverage short volatility trade, the risk parity trade, and the basis trade.
I think that never ends well. The type of there's some financializations I think are developments that I think are important. Let's say the housing market. I mean, it's crazy to think that, how long it takes for you to buy a house today. Still, you have to go through so many people to get the deal done. While maybe in a few years and maybe a decade or so, I think this whole industry will look very different. So there's parts of that, and I know you're not referring to this as a development, but those parts are certainly more interesting and will probably unlock a lot of value. We talk about a lot of the even when you think about the other private markets like athletes or so, it's how do you buy a participation or a stake on an athlete today? I mean, it's very difficult to participate on those markets. So there's a lot of value to be unlocked in different markets in terms of that I think it's interesting. That has nothing to do with creating a bubble. Now, in terms of leverage products that you're referring to, certainly that's a scary part of the cycle, and I think that's all part of a cycle in which you start seeing the lack of growth in assets that kind of fuels the need for leverage plays in order to make your minimum returns, and regardless if it is a pension fund or a university, whatever that is. I think that's all aligned with where we are in terms of the economic cycle globally. I've been seeing a lot of products like that recently as well. And unfortunately, a lot of ETFs are the ones that scare me the most, which, I hear people wanted to buy gold, for instance, and they buy JNUG, the ETF. I mean, what in the world why would you buy that? I mean, that's just not a good product. And certainly is a very low liquidity inside of the ETF. And a lot of those ETFs, people don't really look at inside of them to see what are the assets inside of them and how much liquidity there really is. Some of those ETFs are more liquidity than their holdings. So obviously this works until it doesn't. And unfortunately, it's all about liquidity at the end of the day. And when liquidity dries out, a lot of those investments can be in trouble. And I think it also relates back to that whole corner that I said, that the Federal Reserve is painted into a corner. If they want to continue to increase liquidity to fund fiscal stimulus, some of those things can continue to exist and actually coexist with the markets and continue to gain more momentum. Now, if we go the other route, which who knows what they're going to do, if they're really worried about the dollar, worry about silver and gold prices moving higher, there is a case to be made that they might be trying to hold back a little bit. And if that's the case, I think liquidity is going to dry out very quickly. I mean, just look at the what happened with the corporate bond market back in March, as you said it many times. And that is a scary, scary part of the market. It still is. If you take the Federal Reserve out of that market, the whole thing collapses. And because it makes absolutely no sense. It's a huge divergence between leverage in the system versus, cheapness of in order to raise capital. And I'm referring to corporate bond yields right now at being record lows. And I've never seen a cycle start with corporate bond yields at record low levels. And that never happened in the history. So, again, it's just it's nice to combine those things with your view about your macro views about what's going on in the markets today. And certainly, I think that's one way to do it. And I'm not a fan of any leverage type of product that is especially being sold to people like retail investors.
Yeah, and retail investors buy and hold some of these things like USO when it was having the problems and JNUG, and they just lose a lot of money. And these things are designed for day traders. So they're not good products, like you said, but then retail investors who are not day traders are buying these things because they're thinking the rationale is that if gold goes up, then this is going to go up 3x. And that's not how the products are designed.
No, gosh. I mean, how many times I have friends, messaging me and saying, should I just buy gold or should I just buy JNUG? I mean, I don't know. I actually have an answer kind of typed already. I just copy and paste. Don't waste my time.
Yeah, I agree. I'm tired of getting that question too. Well, Tavi, you've been very generous with your time today. Thank you so much. If my listeners want to follow your work, you put out excellent charts on your Twitter. How do they follow you on Twitter? And also take a look at your global macro newsletter on the Crescott Capital website, which is free, right?
Yes, it is free. Thanks again, Jason, for having me here. I really appreciate it. So my Twitter handle is at Tavi Costa. Our website is crescat.net. We post a lot of letters, usually monthly, and they're all free and all available on our website. I also have an Instagram account that is growing. That I just think it's an interesting way to publish your views along. It's very similar to Twitter in my view, in which my handle there is at Tavi Costa Macro. It's growing slowly actually. Why not? Why not spread a little bit more of my views in other platforms? And it's been very useful. But thanks again for having me. I really appreciate it.